Welcome to all of you tuning in live to our Acuvest webinar, and indeed to those listening to us on playback. Our topic for discussion today is what to do when cash and bonds cost you money instead of providing a return. Just some housekeeping, you can submit questions during the webinar, and I do apologize in advance if we don't get to all of them due to the time restrictions. You can also submit suggestions for topics to be covered on future webinars. Joining me today is Chris Johns. Chris is well known in Ireland. He's an experienced economist and investment strategist. He served as Chief Investment Officer of Fundamental Equities for State Street Global Advisors for a number of years. He currently writes a column every Monday for the Irish Times, and he is a member of Acuvest's Investment Committee. Welcome, Chris.
Thank you, John.
Chris, a lot of people have cash. I was looking at the stats. The central bank stats show that the level of household deposits alone increased by 7.3 billion in the period from the end of March to the end of July. And people are unhappy that they're already experiencing negative interest rates in their pensions and indeed in their businesses. And now we hear that the two main banks are openly discussing charging for regular deposits. And of course, the negative yield environment they find themselves in is very challenging for their business models. So with that, I just want to put up a chart here, Chris, if you give me a second. So what we're looking at here is a chart showing the bond yields for the German and US 10-year bond yields and how those have fallen over the last 20 years. And you'll notice on the right-hand side of the chart here, the red circle line, it shows that the blue line, which is German bonds, has gone below zero into negative territory. But so too, the US bond yields have fallen very significantly. In fact, arguably before COVID hit, there was some sense that perhaps what would happen is the blue line would come up to meet the US line. And I think since COVID, what we're looking at now is a world with zero or negative yields. And against that backdrop, of zero or negative cash returns, people are motivated to move their money. And there's a narrative out there from asset managers that they have good model portfolios that provide a safe alternative to cash. And Chris, when we get to the end of our webinar, I think it would be helpful if through our discussion, we've answered some of the following questions. Are there indeed new safe assets, real alternatives to cash? Are bonds in fact safe? Should people embrace the traditional 60-40 portfolio approach that has done so well over the last 20 years? And what are the choices available to investors? But to answer these, we need to start by looking at the bond market, Chris. So, Chris, why is the bond market so important?
That's a great question. One of the things that we investment professionals learn early on is the importance of bonds, and we often marvel at the way in which the business pages of many a newspaper really don't cover bonds in any material way. It's far more interesting and story driven to talk about stock markets at an aggregate level, or indeed individual share company prices. We see headlines like Apple is now worth more than the FTSE 100, for example. But bonds are arguably at least as important. I know a couple of finance professors who would argue that the bond yield is actually the most important variable in finance and pretty much determines everything. It really is the most important market. Our house prices, our equity values, all assets are connected in some way, usually very directly, to bonds. They're incredibly important. So it is something of a mystery to investment professionals as to why they don't attract more attention. The bond market, as you can see here in this slide, has grown enormously over the last while, particularly in recent periods. The biggest part of any bond market, be it any country or indeed the world, is the government bond market. This is the money that you and I, through our pension funds, through our insurance policies, lend to governments. And mostly as a result of COVID, but also for other reasons, governments have been issuing a lot of bonds. But it's not just governments. Companies borrow money in this way. Companies finance themselves not just through the equity market, but also, and increasingly so, through the bond market. And these bond yields, as I say, tend to determine everything. It's not just the value of the equities, but the companies themselves, the equity market, the equity prices are determined. But when indeed any company, Apple or any individual corporate entity is engaged in investment, whether it's building a new factory, investing in plant and equipment, or indeed investing in people, the bond yield is the most important determinant of whether or not a company invests. So it affects all our financial lives, and it will continue to do so. The Bank of England published some research recently which said that for all the furore over the headlines over house prices going up and down and supply and demand, the thing that in the end determines the price of the properties that we live in is the bond market. So it's incredibly important.
And Chris, I'm looking there at the numbers you've up in your chart there at over 128 trillion, and it strikes me, I mean, I know the value of the equity market and it will vary, but it's probably 95 to 100 trillion as well. So you're talking about a market that's, you know, probably a bit bigger than the equity markets. And as you say, we hear very little about it very often.
Yeah, that's right. It's a curiosity, but it is, as we say, it is what it is. But it's always been important, and it's going to be even more important going forward, because bonds have comprised a lot of our investment portfolios, whether we realize it or not, whether we, you know, particularly through our pension funds. You mentioned the 60-40 fund, which is a classic standard investment portfolio of choice for many an investment advisor. 60-40 is illustrative. It isn't necessarily precisely that, but that 40 has traditionally been bonds. And one of the reasons, as you say, that investors have been rewarded in recent times is not just because the 60% has done well, that's the equity market, but bonds have done well. And the reason for this conversation today is our concern, our worry, and indeed perhaps our expectation that the future really isn't going to look like the past, for bond markets at least.
And it's indeed surprising, because one of the things that I'm increasingly reading about, Chris, is that, and I know we have a slide coming up here to illustrate this, but the volume of bonds now globally that are negative yielding is truly sort of astounding when we look at it. So if I just put up, and I'd ask you just to chat to that, and what's driving these negative yields?
Well, this all started really in the most recent past with the financial crisis. And you probably remember that during that, the way in which central banks responded to that crisis was through something called quantitative easing, which is a piece of jargon which essentially meant money printing. They printed money to respond to that crisis. And the technical way in which they do this is that they buy bonds. Initially, it was just government bonds, but more recently, they've been buying all sorts of bonds. The ones issued by corporates in particular have joined the list of things that they are buying. So governments issue bonds, central banks buy them. That's a technical transaction within the government. It amounts to money printing, and that really involves a huge increase in the demand for bonds. You might think it artificial, given that it's government supply and government demand, but it does represent a massive increase in demand relative to supply, which drives the price of bonds up. And the way these things work is that when the price of bonds goes up because of that excess demand, bond yields fall. There's other determinants of bond yields. One is inflation. Bond yields typically are higher in inflationary environments and vice versa. Economic growth matters for bonds, and one of the things that's happened is that growth has been fairly lackluster in recent years. That has also driven bonds down, bond yields down, bond prices up. Another reason is institutional demand for bonds. Some of your listeners may well be involved in the pension fund industry, and we all know the importance of bonds for pensions. The way in which pension funds, many of them, are valued, particularly defined benefit funds, depends on bonds. And many pension companies have been forced to buy bonds for matching their liabilities, for matching their future pension needs. So the demand for bonds is huge relative to the supply for a number of reasons, which I've just gone through. That's pushed the price up, and that has pushed the bond yield down. And in many cases, as you can see from this chart, the yield on the government bond has actually gone negative. Which is a state of affairs that nobody would have predicted. Nobody did predict it. And the extent to which it's happened has also caught people by surprise, because it's mostly a story about government bonds, but also one or two corporate bonds. companies have been able to issue bonds from time to time in the most recent past at zero, near zero, or sometimes even negative yields. So I think probably since this chart was drawn in recent weeks, then the newer data would say that the negative yielding debt has actually gone up rather than down.
Well, and of course, that poses a particular challenge for all of us as investors, because something that we used to in the past, provide us with a return. Now, in a sense, what we're being asked to do is to pay governments or corporates in order for the privilege of giving them our money for a period of time, which is indeed a turn of affairs. Is this temporary though? Is it possible that what we're looking at is a very short term, in the scheme of things, a short term reduction in yields, or is this something that's been going on for quite a while?
Well, we got all of us investment professionals are brought up on the idea that government bonds should yield something. And a lot of the ways in which we think about asset pricing, the price of equity markets, for example, depends on there being a positive bond yield. So when we see zero or negative yields, we recoil and we think this can't be sustained for very long. And you'll have seen commentary in recent years. I think most people would have said this is a temporary state of affairs. But a couple of things have happened over the last while to lead us to think that maybe, quite likely, it's going to last for a lot longer than we previously thought. First of all, there's the particular example of Japan. Japan has had these zero, they were the first country to get these zero yields. And just as with all of the other markets more recently, people said this can't last. But the simple fact is that it did. And Japan has had zero or negative yields for a long time now. And so this Japanification of the bond market is an example of it, something that we thought temporary, lasting a lot longer than we thought. The fact that it's spread to other countries is another pointer to suggest that it may well be a longer lasting phenomena. And when you look at the list of drivers, the things that determine bond yields, the list that I just went through, none of those look as if they're going away very, very soon. And so I think that most investment professionals have now come to the conclusion that the risk is that these low bond yields are here for the foreseeable future.
And one of the things that you actually had shown me, and I was going to put it up here in a slide, is in fact, when you take a very long-term look at bond yields, there's reason to believe that we've been doing this downward trajectory for quite a while. This is quite a busy chart. I know it's a favorite of yours. You might just, take us through it, please.
Yeah, this is path-breaking research recently published by the Bank of England. And it goes through global bond markets all the way back to the 1300s. Now, I'm a data geek, so I love this sort of thing. And I know it's not everybody's cup of tea, but there is an awful lot of important stuff going on here. You mentioned that it's a busy chart, and that's the first thing that one must immediately say, is that bond yields historically do go up and down. But the Bank of England has found, this is the red line in this chart, an inexorable trend for bond yields, and that we've cast it in this chart in real terms, which is taking account of inflation in the yield that's being offered. And it shows that, for many centuries, there's been a downward trend in bond yields. So that's another reason for adding to the ones that I've just suggested, the traditional ways of thinking about bonds, but there's also their own history that suggests that something's going on that has led bond yields to fall through history in a trend way with a lot of volatility, it has to be acknowledged. And it's another reason for thinking, well, maybe there's something going on here that we didn't fully appreciate in the past, and that based on data, based on the fundamental drivers of bond yields that I mentioned, that all adds up to that red line staying down close to something like zero for the foreseeable future.
And that's very challenging for us again, because with that type of perspective and outlook, I guess as investors, we have to prepare for the fact that we may be dealing with, very low returns, looking forward. And it brings me to the question, because you mentioned this is a chart that's looking at real yields. And I'm going to just flick on to the next chart where we look at inflation. And there's a couple of, the top chart is looking at EU inflation, the bottom one is Ireland. Let's just look at Ireland first of all. You can see, and directly as a result of COVID going on, and COVID by its very nature in terms of stopping the economy is deflationary. We can see in Ireland that the latest reading from the Central Statistic Office we're down to minus 1%. But if we broaden it out to an EU level, you can see that the EU now for 2 months running have had negative inflation. But presumably, Chris, while the current, period and the challenges we have at the moment of COVID, etc., is probably deflationary in its impact, presumably as you look a bit further out from the point of view of their retirement savings, etc., the fear has got to be that inflation re-emerges. And it feels to me then in that environment, we have two challenges, with cash. We've got the challenge that there's going to be zero or possibly negative interest rates. And the second one is if we've got positive inflation, it's eroding the purchasing value of our savings. You might just comment about the inflation and how that fits into this picture for people.
The inflation connection with bonds and indeed everything else that we invest in is incredibly important, and there's a lot going on here. The future is unknowable. We at Acuvest, as you know, never claim to have a crystal ball. We make guesses about the future. We make very educated guesses about the future, and we always start by saying we don't know. We have to be prepared for a number of contingencies. The contingency that's worrying me most at the moment is that this is a line that's going, unlike the bond yield one, is going to prove temporary. The reason why you might still, despite all my concerns about bond yields, be thinking that bonds are still a good investment, for example, an important part of this chart is contained in those red bubbles at the end, is that if you thought that this inflationary environment or disinflationary environment, deflationary environment was likely to continue, bonds might actually still be a reasonable, not a spectacular, but a reasonable investment. I don't think that we are in that kind of deflationary environment. But one of the reasons why bond yields have come down is because inflation has come down. And one of the reasons why I think that inflation might go up is connected to the comments that I just made about that quantitative easing, the money printing that's going on. Yes, we are in this environment where inflation is negative. But as an economist, I will tell you that if we keep on printing money in the way that we are right now, particularly once COVID is over, I think that inflation is likely to go up. And that will erode the real returns that you have on your cash and your bonds. And it will present a very difficult environment for bond investors, because we haven't had a secular rise in inflation for over 30 years now. We've had temporary blips, but we've gotten used to thinking about inflation as a non-problem. I'm not saying it's definitely going to happen, but my number one concern for the years ahead, not the months ahead, is that we will be starting to talk about inflation again. Not necessarily to the same extent that we did in the 1970s, but we might start to think about a rerun of that era in perhaps a smaller way.
And isn't it fair to say that we've got some pretty powerful actors who are motivated to try and generate that inflation, i.e. through the central banks? And, I noted that in the US, the Fed, for example, have made some tweaks to their outlook and policy. And in a sense, what they're trying to do is to say that not alone are we targeting to get to inflation of 2%, but in order to get there, we'll tolerate going a little bit past. I'm paraphrasing here, Chris, obviously. And, and I think the same thing will happen in the other central banks, that they are actually motivated to try and generate some inflation. So that's another sort of.
Always look for the vested interests, and the vested interests of the last 30 years have been to get inflation down. That first chart that we showed, where there was a huge amount of bond issuance going on, creates a vested interest for those people issuing the bonds to create a bit of inflation, because it does erode the real value of that debt. It imposes a tax on bondholders. That's you and me via our pension funds and other savings. It's in the jargon, it's called financial repression. We had it after the Second World War, and there is a concern, a belief in some quarters that we are going back into that kind of a period. And the way it works is that the central banks will keep the value of bonds where they are by continuing to buy them, but will push inflation up. You mentioned the Federal Reserve. Ever since the days of Paul Volcker in the early 1980s, a long time ago, central banks have been operating in a particular way, and we've gotten used to that. A big change was announced very recently, as you said, by the United States Federal Reserve, to say that they are changing the way that they are operating, that they are going to tolerate, if not actually encourage, higher inflation. That's a dramatic change with dramatic implications if they succeed for bonds and anything else related to them.
Yeah, no, it's interesting. And You know, the flip side of this, obviously, you know, as a country, we're having to borrow more. We're going to borrow probably 30 billion more this year just to deal with the current crisis with COVID. And I guess from that point of view, low interest rates are very, very good. But the flip side of that, as we're talking about today, that means for our savings, our pensions, investments, you know, it's poor to have those low rates. And it's also, you know, it strikes me, you know, these low interest rate environment is also very challenging for our banks, you know, because, you know, and it's challenging for them to make money, which is again the reason why they are now starting to put the narrative out there that they'll begin charging for deposits.
Absolutely, that's a logical consequence of all that we've been talking about. Is twofold. One, the banks find it very difficult to make money in this environment. Banks traditionally make their money by borrowing at one rate, lending at another, where that rate at which they lend is higher than the rate at which they're borrowing. They find that very difficult. Their profit margin, if whatever industry that you're in, your profit margin is the ultimate driver of your business, and banks' profit margins are getting squeezed dramatically around the world. And that's why they have to reduce the cost at which they borrow the money. They have to get their cost of goods sold down, and that's the interest rate that they're prepared to give you for your deposits. And that's why the two main banks are talking about charging you for the privilege of holding your money on deposit. That has enormous implications for all sorts of people, both in terms of their daily lives and in terms of their pensions and savings.
So I hope that part of the conversation has helped our listeners, Chris, to understand that there are some pretty powerful forces, namely through the bond markets and what's going on in the world, that underpins why we're at a stage now where we have low to negative returns on cash and bonds. But it does raise the obvious question then for people who are listening in today. So what are the alternatives out there for people? And I thought we might look through a couple of these, and sorry, more than a couple, but I thought we might start by, and you referred to it, and I referred to it in my opening, and you referred to it in one of your comments, there's something called a classic 60-40 portfolio, and we might just chat about that, and then we might go on to talk about the other types of ideas that we see typically espoused as being an alternative to cash. If I could just, in terms of the 60-40 portfolio, just to give a little bit of a definition around that, and as you say, this is more sort of, the main thing here is that in the classic portfolio, you had 60% in equities and you had 40% in bonds. And on the bond side, typically you were earning a reasonable amount of income. And the view was that if you did have some trouble in the equity markets, that the bonds would then hold up and create the balance in the portfolio. And the truth is that type of portfolio has been very valuable to investors, particularly over the last 20 years. And you might even say that that portfolio has outperformed over the last 20 years, because going back to the first chart that we showed, what we have seen is a sharp fall in yields. And of course, as you mentioned earlier, as yields go down, capital prices go up, or the value of our bonds go up. So they have performed very, very well. And certainly anyone who's taking a decision by looking in the proverbial rearview mirror would say, okay, 60-40 portfolio has done very well. It's given me a reasonable return above cash. I'll just move there. But based on everything that you've just said to me, it seems to me that, you know, doing that might come with some surprises. Can you just comment on that?
Yeah, and I think we need to spend 30 seconds thinking about why we originally, all those years ago, suggested 60-40 portfolios for investors, for pensioners, for savers. And we went into bonds. We put the 40% or something like that into bonds for a number of reasons. The first was that it offered a positive return. So if you bought a 10-year bond that yielded 3% a year and held it till maturity for its full life of 10 years, you knew with certainty that you get 3%. You might have been a little bit worried that inflation would take off during that period and erode the real value of your returns, but you knew that you would be getting something back and that your money was safe in some meaningful sense. As you said, you actually got more in many cases than you thought that you would, because the price of the bonds went up during that period, so you could avail of increases in the capital values. And that's one of the reasons why 60-40 portfolios did much better than people had any reason to expect when they first went into them. The other reason for going into this kind of portfolio is to do with safety, sleeping at night, lower volatility, and not being fully exposed to the vagaries of the equity markets. We know that equities can do anything to you on a day-to-day or month-to-month or year-to-year basis. They are great assets for the longer term, but people can often be shocked by what they can do to you in the short term. So we put people into bonds because they were nowhere near as volatile as equities, and investors always told us they wanted to be able to sleep at night. They didn't want to have the rock and roll ride of a 100% or a much higher percentage that equities would give you. So we described bonds as safe assets. In many ways, that to be true. They've turned out to be safe. They've turned out to be more than safe. They've been reasonably high return safe assets. But there is no such thing as a safe asset, actually, John. And they weren't safe back then. They were always risky. The thing that happened to bonds was that the risks that you took when you went into them didn't actually come to pass. I talked about one specific risk, which is that inflation could have eroded your returns from bonds. It didn't happen because, as we've seen, inflation actually came down, boosting your real return. So they look safe and they turned out to be safe. But when you were going into them, they were not necessarily as safe as we thought that they were. There is, in fact, in my opinion, no such thing as a perfectly safe asset. It's a relative concept. Some assets are safer than others. Some assets are more volatile than others. But the key point is that the characteristics that bonds gave to your portfolio over the last 10, 20, 30 years are, in my view, unlikely to be the same ones going forward.
And that does produce a particular challenge for investors, because in many ways, I suspect, and certainly a lot of our clients would describe that they would want to be able to sleep safe, at night, not have to worry about this stuff. And, as an industry where we're saying we don't have the same tools, and the things that were safe in the past may not be safe, in the future. And I think that's very, very challenging. So what are people doing? Because what that says to me then, so if in fact what we get is interest rates remaining low or increasing, we may actually have capital losses with our bonds, part of our portfolio. If, as you say, inflation reemerges, that will be a challenge to the bond part of the traditional 60-40 type portfolio. So what are the alternatives for people at this stage? What types of things are people talking about?
There's no easy solution, and you have to be very careful about the solutions that are being presented to you. The first thing I'd say to you is that be very wary of people that present to you the idea of a safe asset. It doesn't exist. Every asset, including bonds, come with risks. I do think that bonds are going to come with higher risk in the future than they come with in the past. There is no, there is no such thing as a safe asset. Even bonds, you might not get your money back. And some investors in the Greek bond market will tell you that there is a risk, a recent risk that you might not actually get your money back, let alone an interest rate return. So be very wary of the language that is being used, and understand that nothing is safe. Everything comes with risk attached. The second thing I'd say is that you've got to adjust your expectations, and that the kind of returns that you got from a 60-40 portfolio in the past are most unlikely to come to pass going forward. If you buy into my worries about inflation, you think that the 60-40 portfolio might actually be quite a dangerous place. If you do, however, disagree with me, and you think that, for example, we're in a big deflation that will last for years, then the 60-40 portfolio might still be something that you would want to go into. I would caution against that, but that's all about that views, beliefs about the future are very important for investors to understand either what their beliefs are or what the beliefs embodied in a particular portfolio are.
And so just on that point, Chris, if I could just bring in the next slide, because I think it ties in with that. I had our team just look at the performance of some of the portfolios that are out there. They're modeled, they're not 60-40, they're probably more like 40-60 in truth. And these are taken from a sample of providers in the market. And the green line here is showing you an investor what they'd have in cash. So you can see that they would have lost a bit of money, in cash. This is a forward-looking basis if we get to the point. And this would be exactly how it would look for somebody inside of, for example, their pension or their ARF, that would be losing a little bit of money through cash. These particular funds, what you can see is when we did have the correction in March time period, that they did go down, and albeit they've come back a little bit, I think the question and the thing we want people to be aware of is if that was not their expectation, if their expectation was the funds they were going into, because they tend to be called things like cautious or conservative, they have nice marketing names around them, which I think for some people suggests that they're not going to lose, much money. And I just wanted to put that out there in terms of, to your point.
Yeah, I mean, that's my point about the use of language and that word safe that I referred to earlier on. Sometimes language can be fuzzy, and so that if you are investing in something that's labeled cautious or managed, then if the expectation is that you can't lose much money and or you won't experience much volatility, I think that's going to be very challenging going forward, and that view, that expectation will be challenged. And it's again a reminder that we've got to be very careful about our use of language and the expectations that we set up.
So presumably then, if on the one hand, I think what we're saying very clearly is that there are no new safe assets out there. So there seems to be a choice for investors. It's either, you want to stay in safe assets, or you need to take on more risks. And in staying in safe assets, you've got to accept far lower returns looking forward. But if people are going to take on more risk, what are the types of things that people are looking at? What are the asset classes that we're seeing most activity in, or at least being espoused by the various managers?
What we're seeing is people suggesting that it comes under the heading alternative assets. And this is another fuzzy word in the language that involves many different things. We've all heard of hedge funds, and most of us will have heard of private equity. Those things are mentioned most often. There are investment managers out there who try to take account of all of the things that we've just been talking about, and they don't exactly promise, but they suggest that they can weather all of these storms and deliver what are called absolute returns, which is a piece of jargon that means positive returns in all weathers. We also see other slightly more exotic things like art, wine, forestry, mentioned as potential safe assets. I would never use the word safe assets. I would use safer in some contexts, but never use the word safe. Another favorite that is often mentioned is infrastructure. This is very popular because governments in particular are clearly gearing up to spend a lot more money on roads, hospitals, education, broadband, and the like. And the potential for returns from there has been around for some time, actually, but is still very much there. I think that all of these things, to a greater or lesser extent, are interesting. I'm very wary of them being fashions and fads, because one of the things to avoid in investing, a good rule of thumb at all time, is to avoid what everybody else is doing, because that can often involve herding, and therefore the price that you pay for these investments is too high from the outset, which is very damaging for returns. So you have to be very careful. But the message is that it isn't easy. There is no simple answer, and that you've either got to continue what you're doing in the past and expect lower returns, or take more risk in the hope, and it is only a hope, that you will generate something like the returns that you've gotten in the past.
I'm conscious of time, Chris, but I just wanted to ask you about one other asset class that you haven't mentioned, which is property. So I certainly see it in working with clients. And one of the reasons why I like it when I'm working with clients is it is nice to have the yield side of it, the income side of it. It's more difficult to predict what might happen on the capital appreciation side of it. But presumably it's another asset class that can fit into that category list that you gave.
Very much so. And we describe the 60-40 portfolio in terms of traditional cash and bond, equity and bond portfolios. More realistically, they were often a 60-30-10 portfolio, where the 10 was real estate. And I think real estate will continue to have an important role to play here. There are huge questions, of course, being attached to real estate investment, both commercial and residential, not least because of COVID-19. Commercial property is currently deeply unfashionable everywhere, and I think that makes it a very interesting investment. That's that point about herding. If you want an unfashionable investment at the moment, commercial property certainly fits the bill. And residential property is holding up much better than anybody thought as a result of coronavirus, and that has interesting aspects as well. But these investments do offer the potential for return. But the key issue here is that they are not safe, they are not risk-free.
And actually, it strikes me when you say that one of the things that we've known over the years in working with clients, Chris, at Acuvest, is that, you know, in order to be able to take advantage of opportunities that might feel uncomfortable, such as you mentioned about the challenges around property, I think the way to do that is to have a plan, and that you have a plan thought out in advance, because it is the time when it'll feel most uncomfortable will be the right time to go and invest and go against those herd mentalities, as you said. So with that, Chris, I'd like to draw this webinar to a conclusion. I think that there are summed up here on our slide 4 sort of key messages that Chris and I would like to leave you with, and Chris, by all means, add more if there's any that come up. The first thing I think we've said clearly is there are no new safe assets, and the fact of the matter is cash will probably cost money now going forward. Bonds, instead of being a risk-free asset, have turned out to be a return-free risk, to offer you return-free risk. So we really are just getting you to think carefully about bonds. And I think your choices, as we've said a couple of times now, are you either accept the lower returns or you've got to accept more risk. And if you are planning on taking more risk, we have a very clear and simple step 1 is develop an investment plan. It's only with the plan then can you decide that the various portfolios being offered to you, whether or not they fit with your plan. Is there anything you would add to that, Chris?
That's perfect, John. Thank you.
Okay, so with that, I would like to thank everybody for tuning in today, and I would like to thank Chris for your time. Thank you, everybody, and goodbye.